Despite being the dog days of summer, the market volatility is heating up as we suspected it would. Headlines are blaring messages of doom. This week we deconstruct some of the real truths behind that as part of a two-part series called Buying Time. So market volatility has picked up dramatically here to start August. Headlines are beginning to blare all sorts of scary stories, and investors are understandably getting spooked. So we wanted to tackle some of the big issues and really step back, give you some perspective you wouldn't be hearing elsewhere, as well as some of the reasons to actually be positive and optimistic here looking out at least a few months. Let's start with the one that's dominating everybody's attention, trade. If selling off your portfolio or running for the hills was how you thought you should respond to trade, A, you should have done it last March. B, had you done it last March, you would have missed out on about a positive 6% return in the S&P 500. Point being there, the assumed equation that trade wars equals market meltdown hasn't held up. Is it good for the global economy? No. Do we hope there's a resolution at some point in the near future? Of course. But it alone is not going to derail the global economy. You already see companies adjusting and moving out of China to help avoid some of those tariffs that, again, have now been put off till 2020 in their implementation. We don't think this is going to get settled right away. We do think it gets settled in 2020. But again, it is something you can plan about, and we wouldn't let freak you out when it comes to your portfolio. Headline number 2 that's scaring everyone, the yield curve inverts. We wrote about this when it happened for the first time back in March 22nd to be exact. You can go back and check out that piece. Here's some key things to know. Number 1 is I don't know that a yield curve means inversion means what it used to mean. And we talked about this in March, which is before you had the amount of intervention from central banks that you see around the world now, before you had as many negative interest rates as you see around the world right now, that yield curve inversion was an accurate forecast of the supply and demand of different places on the curve, as well as what it means to the bank's incentive to loan, that did have real economic consequences and reflect underlying economic realities. It could be that today, but I think to ignore all of, again, that central bank intervention, all the foreign countries that have negative sovereign debt yields and how that's thrown out the supply and demand for sovereign debt around the world would be a huge mistake and quite frankly irresponsible. Even if the yield curve does mean what it's historically meant, the average returns after a yield curve inversion aren't, again, what you're probably hearing in the news, which are telling you, again, that it's a signal of impending doom. In fact, if you look at the 3, 6, 1-year, and 3-year returns, they're up 2.5, 4.9, 13.5, and 16.5% respectively. So again, that's not to say it has to play out one way or another. But again, for those people who are saying trade war equals market meltdown, yield curve inversion equals market meltdown, history doesn't show it to be that way at all. Furthermore, we see some real positive catalysts, and we've been writing, again, we wrote floors and ceilings and told you, hey, here's the setup, here's what's happening. We've had modest, I think we're up about 6% since December, all told. Again, just S&P 500. A lot of the other indexes, Russell 2000, are negative. But here we are in this range-bound market that's played out. And we told you, hey, as we head into the back half of this year, into 2020, the year-over-year comparisons get easier. You still got a stimulative Fed. You're probably going to get a trade deal at some point. Corporate earnings picture should begin to brighten a little bit. That all still looks very much intact. Furthermore, you've got $2 trillion worth of federal fiscal stimulus set to hit that's going to be a boon for the economy. If you look at that corporate earnings picture, despite the trade narratives that are being spun, 90% of companies have reported this quarter. 75 beat their earnings expectations by an average gain of 5.7% above expectations. So this, of course, doesn't make for sexy headlines, but it is happening. And again, reflective of that truth that is what you really need to hang your hat on as an investor, which is companies are dynamic, they're innovative, they'll adjust. And so yes, there can be headwinds, yes, there can be troubles, but time has shown that companies will find a way to get around, to find that way to make good earnings and push the market higher over time. Just even the macro data this week, and then I'll wrap this up. Retail sales were up, Empire Manufacturing Index up, U.S. worker productivity up, Philly Fed Index up. I would be shocked, unless you're getting down onto page 3 or 4 of whatever periodical you're reading, that you're seeing those headlines, and yet that's actually happening here in the U.S. So selling into weakness or trying to buy into strength is certainly how we all are wired from an emotional perspective, but it is not a sound investment strategy. The fact of the matter is, and again, we've stated this to you before, yes, some 5% corrections do turn into 20% bear markets. But on average, if you looked at 5, 10, and 20% drops in the market, each level only gets to the next 20% of the time. And so while it does happen, selling when the market's down 5% because you think it could go to 10, you're going to be wrong the vast majority of the time. And that's, again, why you see investors so woefully underperform whatever they're investing in when they get tugged back and forth based off market volatility. It's coming. It's probably here for a little bit to stay. We do think it abates in the back half of this year. The key then is buying time. Stick around for next week's video. We're really going to talk about how to approach these markets from a mindset standpoint, depending on where you're at in your investing life cycle. Thanks so much.